Listen up. If you've been making money from your side hustle and thinking the IRS won't notice, I've got news that's going to shake up your entire 2025. The IRS just dropped massive new enforcement changes specifically targeting side hustle income, and millions of Americans are about to be caught completely off guard. Here's what's happening right now. That Etsy shop, your Uber driving, freelance gigs, reselling on eBay. The IRS has new systems in place to track every single dollar you're making. We're talking about sophisticated technology that's monitoring digital payments like never before. And if you think you can fly under the radar because you're only making a few $100 a month, think again. The payment threshold that used to protect small earners completely changed. Third-party payment platforms are now required to report transactions at levels that will impact almost everyone with a side income. We're not talking about some future rule. This is happening now, and the penalties for not reporting are absolutely brutal. But here's the thing. I'm not here to scare you. I'm here to arm you with the exact information you need to stay compliant, protect yourself, and actually keep more of your hard-earned money. In this video, I'm breaking down every single change, showing you exactly what triggers IRS attention, and giving you the actionable steps to bulletproof your side hustle against audits. If this information is valuable to you, smash that like button right now. It helps more people discover this crucial content before tax season hits. So let's dive straight into what's actually happening here, because the changes the IRS has implemented are way more significant than most people realize, and I want to make sure you understand not just what's changed, but why it matters to you personally and what you need to do about it immediately. First things first, we need to talk about the elephant in the room, the 1099-K reporting threshold. Now, if you've been doing any kind of side hustle work over the past few years, you might have heard about this form before. But what you probably don't know is that the rules surrounding it have been completely transformed. For years, the threshold for receiving a 1099-K form was set at $20,000 in gross payments and more than 200 transactions per year. That was a pretty high bar, right? It meant that most casual side hustlers never hit that threshold, and therefore never received this particular tax form from their payment platforms. But here's where everything changes. The IRS has been working on lowering that threshold dramatically, and we're now looking at a reporting requirement that kicks in at just $600 in annual transactions. Let me repeat that, because it's absolutely critical. $600. That's not $600 in profit. That's $600 in gross payments. So if you're selling handmade crafts on Etsy, driving for Uber on weekends, doing freelance graphic design work, or flipping items on eBay or Facebook Marketplace, you're almost certainly going to hit that threshold if you haven't already. Now, I know what some of you might be thinking right now. You might be saying to yourself, well, I've always been honest about my income. I've always reported everything on my taxes, so this doesn't really affect me, right? And while I absolutely commend you for being compliant and honest with your tax reporting, the reality is that this change affects everyone in the side hustle space, even the most diligent tax filers, and I'm going to explain exactly why that is. The issue isn't just about whether you're reporting your income or not. The issue is about the documentation trail, the administrative burden, and the increased scrutiny that comes along with these new reporting requirements. When payment platforms like PayPal, Venmo, Cash App, Stripe, and all the others start sending out 1099-K forms for transactions as low as $600, they're also sending copies of those same forms directly to the IRS. This creates a cross-reference system where the IRS can now automatically match what you're reporting on your tax return against what these payment platforms are reporting about you. Let me paint you a picture of how this plays out in real life. Imagine you're someone who occasionally sells items online as a side hustle. Maybe you buy clearance items from retail stores and resell them for a profit. Or perhaps you create digital products and sell them through various platforms. Throughout the year, you're making sales here and there, nothing that seems particularly significant on any given day. But it all adds up. Come tax time, you sit down to do your taxes and you try to remember all the income you earned. Maybe you kept some records. Maybe you didn't keep the best records because you didn't think it was going to be that big of a deal. You estimate your income to the best of your ability and you file your return. Now here's where the new system creates a potential problem. Those payment platforms you used throughout the year have been meticulously tracking every single transaction. They know exactly how much money flowed through your account, down to the penny. They generate a 1099-K form with that total amount, and they send it to both you and the IRS. If the number you reported on your tax return doesn't match up with the number on that 1099-K form, even by a small amount, it triggers a red flag in the IRS system. Suddenly, you might find yourself receiving a letter from the IRS asking you to explain the discrepancy, provide documentation, or even face an audit. And this is where things get really important to understand. Even if you were completely honest and you genuinely just made a mistake or forgot about a few transactions, the burden of proof is now on you to demonstrate what happened and why the numbers don't match. You'll need to provide receipts, bank statements, detailed records of your expenses, and documentation of your income sources. This administrative nightmare is something that millions of Americans are simply not prepared for, and it's going to cause massive headaches for people who thought they were doing everything right. But wait, there's more to this story that you absolutely need to understand. The $600 threshold isn't just capturing people who are running legitimate businesses or serious side hustles. It's also catching transactions that aren't even taxable income in the first place. Let me give you some examples that might surprise you. Let's say you and your roommates use Venmo to split rent and utilities every month. If you're the person who collects the money and then pays the landlord, you could easily receive more than $600 in payments throughout the year. Even though none of that money is actually income to you, it's just pass-through money that you're collecting on behalf of others. Or imagine you sell your old furniture when you move to a new apartment. You list your couch, your dining table, and some other household items on Facebook Marketplace, and you receive payments through PayPal or another platform. If those sales total more than $600, you're getting a 1099-K form, even though selling your used personal items at a loss isn't taxable income. You'll still need to deal with reconciling that form on your tax return and potentially explaining to the IRS why you're not reporting it as income. Here's another scenario that's catching a lot of people off guard. Let's say you're part of a group that pools money together for a shared expense. Maybe you're organizing a group vacation with friends, and everyone sends you money through Cash App to cover their share of the vacation rental. Or perhaps you're collecting money from parents for your child's sports team uniforms and equipment. These are not business transactions. These are not income. But if the total amount you receive exceeds $600, guess what? You're getting a 1099-K form, and you're going to have to deal with it on your taxes. The IRS has said that they recognize these situations and that people shouldn't panic about receiving 1099-K forms for non-business transactions. But here's the reality. Saying don't panic and actually making the system user-friendly and easy to navigate are two completely different things. When you receive one of these forms and you have to figure out how to properly report it or explain why you're not reporting it as income, it creates stress, confusion, and often requires professional help from a tax preparer or accountant, which costs money. Now, let's talk about what this means for people who are running legitimate side hustles and who do need to report their income. The good news is that if you've been diligent about tracking your income and expenses all along, These new reporting requirements shouldn't dramatically change your life. You were already supposed to be reporting all of your side hustle income anyway, regardless of whether you received a 1099 form or not. The IRS has always required you to report all income from all sources, period. The 1099 forms are really just information reports that help the IRS verify what you're reporting. However, the increased scrutiny and the automated cross-referencing that comes with these lower thresholds means that you need to be even more careful and precise with your record-keeping than ever before. This is not the time to be casual about your bookkeeping or to rely on memory when it comes to tracking your business expenses. You need to have a system in place that captures every transaction, every expense, every receipt, and every piece of documentation that might be relevant to your side hustle income. Let me give you some practical advice that's going to save you a tremendous amount of stress and potentially a lot of money in penalties if you follow it. First and foremost, you need to separate your business transactions from your personal transactions as much as possible. This means opening a separate bank account specifically for your side hustle, even if it's a relatively small operation. When all of your business income flows into one account and all of your business expenses come out of that same account, it makes tracking everything so much simpler and cleaner. You'll have a clear record of exactly what came in and what went out, and you won't have to sort through mixed personal and business transactions when tax time rolls around. Second, you need to implement a system for tracking and storing receipts immediately. Don't wait until the end of the year to try to piece together what you spent money on throughout the year. There are dozens of apps and software programs available that make this process incredibly easy. You can literally take a photo of a receipt with your phone the moment you make a purchase, and it gets categorized and stored automatically. Some of these apps even integrate directly with your bank accounts and credit cards to automatically import transactions. The key is to do this consistently, every single time you have a business transaction, no matter how small. Third, you need to understand the difference between gross income and net income, and you need to make sure you're deducting all of your legitimate business expenses. Remember, that 1099-K form is going to show the gross amount of payments you received, but that's not the same as your taxable income. If you spent money on supplies, equipment, software subscriptions, advertising, mileage for business driving, a portion of your home internet, if you work from home, and countless other business-related expenses, all of those things can potentially be deducted from your gross income to arrive at your net taxable income. Many side hustlers leave money on the table every year because they don't take the time to properly track and claim all of their legitimate deductions. Fourth, and this is really important, you need to be aware of the quarterly estimated tax payment requirements. If your side hustle is generating significant income and you're not having taxes withheld from that income like you would from a regular W-2 job, you're probably supposed to be making quarterly estimated tax payments to the IRS. A lot of people don't realize this, and they end up with a huge tax bill at the end of the year, plus penalties and interest for not paying their taxes throughout the year. The IRS expects you to pay taxes on your income as you earn it, not all at once when you file your return. If you owe more than $1,000 in taxes for the year, you're generally required to make these quarterly payments. Let me address something else that's been causing confusion and concern in the side hustle community. There have been a lot of rumors and misconceptions floating around about what these changes mean and what the IRS is actually trying to do here. Some people believe this is a new tax on side hustles, or that the IRS is trying to kill the gig economy. That's not accurate. There are no new taxes being created here. The tax laws regarding business income and self-employment income haven't fundamentally changed. What has changed is the reporting mechanism and the enforcement capability of the IRS. The reality is that the IRS has always wanted people to report all of their income from all sources. These new reporting thresholds simply give them better tools to verify that people are actually doing what they're supposed to be doing. From the IRS's perspective, they see billions of dollars in unreported income every year from cash-based businesses, gig work, and online platforms, and they want to close that gap. Whether you agree with their approach or not, it's important to understand what's actually happening so you can respond appropriately. So what should you do right now, today, to protect yourself and make sure you're in compliance with these new requirements? Start by taking inventory of all the platforms and payment methods you use for any kind of income-generating activity. Make a list of every place where money comes to you from others. PayPal, Venmo, Cash App, Etsy, eBay, Amazon, Stripe, whatever platforms you're using. Understand that all of these platforms are now required to report your transactions if they exceed $600 for the year. Next, go back through your records for the current tax year and try to piece together a complete picture of your side hustle income and expenses. If you haven't been keeping good records up until now, start today. It's never too late to implement better systems, and having 9 months of good records is better than having 0 months of good records. Download your transaction histories from all of your payment platforms and save those files somewhere safe where you can access them when you need them. Consider whether it makes sense for you to work with a tax professional, especially if your side hustle has grown to a significant size, or if you're feeling overwhelmed by the complexity of everything. Yes, hiring a CPA or enrolled agent costs money, but the peace of mind and the potential tax savings from having someone who really understands this stuff can more than pay for itself. A good tax professional can help you identify deductions you might be missing, advise you on entity structure if your business is getting bigger, and represent you if you ever do have issues with the IRS. The bottom line here is that the IRS is getting much more sophisticated about tracking side hustle income, and the days of flying under the radar are essentially over. But that doesn't mean you need to panic or give up on your side hustle dreams. It just means you need to treat your side hustle like the real business it is, with proper record keeping, appropriate tax planning, and professional compliance with all the rules and regulations. When you do things the right way from the start, you'll sleep better at night knowing that you're protected. And you'll actually keep more of your hard-earned money because you're taking advantage of all the deductions and strategies available to you.